Welcome to the Titans of Industry show. This is where entrepreneurs, investors, and people want cutting-edge research, and specifically the type of research that requires independent thinking. They come here. Wealth research groups' latest shows have been quite astonishing. We've gotten to explore Dash, the explosive cryptocurrencies, and then we had Jordan Royburn, who talked about how he sees a resource boom, more like a relief rally going into the summer, but not until the S&P 500 reverses course. Gary Christensen, who wrote the book Gold 10,000, the arithmetic story, and Dave Krensler, who went behind the scenes and really did a live numbers crunching of Barrick Gold, the world's largest gold producer. And we had Daniel Ammerman, the entitlement, talking about the entitlement insanity, and industry pioneer Randy Sheepley from the marijuana sector, who discusses at length the cannabis business. Today, I've got one of the greats. I've got Charles Nenner. If you don't know Charles, he's head of research for NennerResearch.com for more than a decade. Using his systems, Goldman Sachs ran their prop trading for over 40% annual returns, roughly 40%. That's insane. This is one of the highly sought after people in the industry, and in my opinion, he's one of those world-class experts that is gifted with an uncanny ability to forecast major trends accurately. And I'm very glad that we get to poke his brain for almost an entire hour here. Charles, how are you?
I'm doing well. How are you doing?
I'm very glad that that you've been gracious enough to share with us and come into the show. I'd like to get your expert research on many things and shine a light on what you think is going to happen with some of the most burning issues in the world's economy. Let's get right to this. And I'd like to ask you about U.S. equities, specifically the Dow, the Nasdaq, and the S&P 500. Looking at some of the catalysts for the markets to continue higher, it looks like the Dow, the Nasdaq, the S&P, they're all unreachable for the average person. It takes almost 28 weeks worth of salaries for the average person to buy a point in these, in the Dow. It's completely insane. And the PE ratios, the sales to earnings ratios, everything is pointing to the fact that this bull market is long overdue for a meltdown, but it seems to go up and up and up, and I don't see it coming down for at least another year. But then, Warren Buffett has said it's gonna. He has seen his portfolio go down 50% twice in his career, and he thinks this will be it might be the third. Ray Dalio is talking about a severe 30 to 50% decline in equities, in U.S. equities. What is in store for people who are now just entering this bull market? Because we all know the retail public is only just starting to buy stocks again after they got burned out so bad in 2008.
Well, first of all, that's usually close to the end. The big story, old story, 1929 of J.P. Morgan, who was taking a taxi to work, and the taxi driver was telling him the latest tips, and he says, okay, that's the end of the bull market. He says, that's one of the reasons I knew we were at the end. It's always the same thing, the big investors that can look forward, they bought in 2009. You can look at my website, so you can check what I'm saying. I give a major sell signal in December 2007, a major buy signal between February and March 2009, based on what we know now. So the news is not going to be taken twice. So that was based on the news what is now. And if you know what the news is going to be next year, then you might say, I'm going to invest now. But then you have to know what the headlines are next year. Now, there are very few small investors who know what the headlines are next year. What is the inflation? Where's crude oil? Where's the unemployment? They don't know anything. They just buy something because next week is going to be higher, which usually doesn't end well. So that's one reason to be very careful. Go ahead.
What do you see going forward then? What is the next year, the next 2 years for the U.S. equities?
well, there's going to be a catastrophe. We said that 3-4 years ago. I said it on Bloomberg. We were looking for Dow Jones 5,000, and we said it's going up the market until later this year, probably the last quarter of this year. And then we should have a very big bear market for a couple of years, which is going to be terrible. Now, one of the things that anybody can think of is that, as you know, all these so-called pundits say markets go up 8% a year. That's based on the average. So if you do the average from 1900 till now, and you draw a line to the average, you have an angle of 8% a year. The only problem is that right now you're 40% above that line. So in order to get back to the average, you have to go down much. You have to go down 40% below the line, and you're back to the average, and then you go 8%. So to say, after market goes up, they had the same problem in 2000. Market goes up 100% for a couple of years, and from that point you go up 8%. There's a total misunderstanding of the numbers.
So the Dow Jones, which today, as we're recording this, is hitting a new all-time high. It's trading at 21,084.46 points. This is going to drop 75% to around 5,000 points. And this is going to happen in the span of 2 years. This is going to be shocking.
4 years. 4 years.
4 years. It really doesn't matter. The severity of what you're saying is beyond comprehension. And just to make
it's gonna be back where it was in 1999. Well, then the world didn't look that bad, so we just get back to economic situation of 1999.
Got it. Okay, that's a nice way to look at that. Do you think that some of the components, some of the companies inside of the Dow will not fall 75%, obviously, and some will fall more than 75%? Obviously, not all of the components will fall 75% flat. So, is there any company that can survive such a decline, or is this going to be a broad panic selling? You're going to see this on TV every day. People are going to freak out, and it's going to crater pension funds.
Well, let's take an example. I just talked about it yesterday. Amazon. Let's say Amazon is good and the market is crashing. Now, there's going to be redemptions. People want to get out of the funds, but the funds has to create money. So they have to take a big profit on Amazon because they need the money. So Amazon will also crash, not only based because they're doing very badly, just because the funds have to make money. Now, before we go further, I want to tell you some part of my research, which I call the 7-year. If you look in 1800 and 1900 and this century, every time a year ends with a 7, there's a major crash. So if it would start in this year, you have to 2017. And before that was 2007. And before that it was 1997, 1998. And before that there was a crash of 87. And before that was the crash of 77, 67, 57, 37, 47. Now, the problem with investors is, and that's opposite to other professions, as you maybe know, is I'm a medical doctor. Now, a medical doctor knows that he has to do something if somebody's pregnant for nine months. He's not going to say, I'm not going to use this idea that after 9 months, I have to interfere with somebody who's pregnant, because he doesn't know why it's 9 months. Elephants, I think, is 20 months. People is 9 months. The problem with people on Wall Street is that they're not too practical. It says, I don't know why it's a year with a 7. And since I don't know why it's a year with a 7, I'm not going to use the knowledge. But for almost 100% of the time of the last 200 years, when the year ends with a 7, you have a major downturn.
So basically what you're saying, which I completely understand, is that I don't need to know how my light switch at my office works. I don't need to know all the everything about electricity. I just know that I need to switch it on when I want to see and switch it off when I leave the room. And you want us to take a look at practical research and say every time, or at least a majority, an overwhelming majority of the time, a year that ends with 7, for some particular reason, we don't know why and we don't care, it almost always generates a market correction, and we don't need to trouble ourselves with why it happens, but just become practical and act on it.
Yeah, but as you know, most people in research and Wall Street don't tell you what's going to happen. They tell you why something is going on and why it's not going on. That's how they earn a living. And, you know, half a year later, you already forgot if the analysis was right or not, wasn't right. What we focus on is we tell you exactly what's going to happen. You want to know why? We study philosophy, go somewhere else. That's not our business. So 99.9% of the research you get is why something is going to happen and not what is going to happen. You understand? So they can say, well, this stock looks good, and maybe it's the buy candidate, but they don't tell you how long it's going to be a buy candidate, when it's going to top, at what level it's going to top, at what level it's going to buy. But they give you a whole story that they have an idea that it might go up. And if you say, I watched this on television, if you say, Mr. Why do you think it's going to happen? He says, I don't know, but nobody knows. So the excuse is always nobody knows. So there are very few people who know, and the public has been educated that nobody knows, so they don't even ask the right questions.
Right. I completely agree with you that the public has been trained to think that the stock market is like a lottery, and they don't look for any kind of a logic, which is obviously not what you should do. You should look at cycles, and you should look at predictability and trends and you know, things that have happened before that might repeat again, and what works.
Right.
And what works. And so in your opinion, we are going back to 1999 level on the S&P 500. Will 5,000 be the buying opportunity of a lifetime then?
Well, I will tell you something. Will it be the buying opportunity of a lifetime? The problem is this: from that moment on, the U.S. market is going sky high. The problem is the dollar is going to collapse. So for U.S. citizens, it's a great opportunity. For foreigners, it's not that simple, because what you're going to make on the stocks, you're going to lose on the currency. So you really have to know what to do, how to hedge the dollar and when to buy. It's a professional world.
So you see a nominal buying opportunity in the indices after they crash, but you don't see a purchasing power buying opportunity, meaning that you do think that nominally the Dow is going to rise again in points, but it's probably going to be because of Fed intervention or currency inflation, and not because the purchasing power of owning the Dow will outperform other assets. Am I getting you right?
Yeah, the inflation is really going to pick up then, and the dollar is going to collapse. So really not getting any buying power, although the stock market can go up 100%, 200%. It's not going to help you.
So why is the dollar, well, not why is the dollar going to crash, but what kind of a cycle, what is your computer seeing with regards to the dollar? Well, the dollar has been for a couple of 100 years already in a bear market, if you look at the charts, and this is just a bear market rally, and the dollar can rally one more time, and then it will continue the bear market again. Now, why will this happen? These things can happen based on some things that happened 200 years ago, because the economy is not something, on contrary what people think, the Fed will do something, there's a new president. They cannot change anything. The economy is a very heavy situation, and it continues for hundreds of years. And whatever was happening hundreds of years ago has its implications of where the dollar is going now. So there's no escape. And when do you see this happening?
Well, I think there could be one more rally in the dollar, another 8-9% up, and then the whole thing collapse. Now, when it's going to happen, I have to look it up. But if people want to see, go to Charles Nenner Research Center. We provide the research for free for a while, because we want people really to see how it works, and all the dates and all the cycles are there. So when we get close, we'll tell exactly where that cycle is. We usually don't tell the cycles too long in advance, because then everybody knows, and we want to protect our clients that they know and not everybody knows.
Sure, I completely understand that. Now, we're seeing in the last 2-3 weeks that at least the smart money, the funds, the institutionals are starting to liquidate U.S. equity gains, and they're starting to enter the cheaper European companies and emerging markets. What do you see in the next 2-3 years, or what do you see overall for European and emerging market stocks?
Well, it's never been the case that the U.S. market goes down and European markets don't go down. So that's the same thing. Now, Europe is a little better than the U.S. short term, but you should know that the valuation in Europe are always historically lower than the U.S. So it's very normal that they're cheaper than the U.S. Emerging market has a big problem with what the dollar is going to do. If the dollar comes down, it's very related to the dollar. You really have to know it works. This is just a temporary thing.
Why are governments buying U.S. Treasury bills?
Well, I will tell you even more than that. I am from the Netherlands, as you might know, and up to 1 or 2 months ago, your note if minus something return. So you got -0, and everybody knows there's going to be some inflation, so automatically you lose money. Well, or everybody's stupid, or the insiders know there's going to be huge risk, and they want to have some guarantee that the governments will back up the T-bills and maybe the bonds, and they take the 0% return, which of course, like I said, will kill the pension funds in Europe, because soon we're going to have 2, 3, 4% inflation, and they're stuck with bonds that give them 0%. So how can they ever take care of the inflation for the elderly? So that's why they buy this stuff. But what they forget is, or maybe they don't remember the history, in the 30s, there were also big institutions who bought treasury bills, but the government couldn't pay it back, and it took years and years until they got the treasury bills paid out. So it's not that it's the same thing as have the insurance for the bank, your bank account in the United States, for $100,000. But wait till something goes wrong. How long is it going to take? I just read that the money they found from Madoff, which was a couple of $2 billion in 2009, has not even paid out 1 penny, and already, 8 years later? So in theory, you're covered, but in practical life, you don't know when you get your money back.
Sure. So basically what you're saying is the fact that so many governments are buying T-bills or any government bond with the fact that they know that they're going to take a loss is because they think otherwise they'll take a bigger loss.
Well, they keep the capital. They're already not thinking, how can I make money? They just want to preserve their money.
Interesting. I want to switch over to the precious metals. Gold and silver have not been used as money since 1971 by governments to back currencies. Silver, more so than gold, has now become really not even part of the vaults of central banks. Gold is still massively bought by central banks worldwide. Silver has become purely a industrial metal for 90% of the time. What do you think is going to? What are your cycles in your computers telling you about the purchasing power of gold and of silver? I'm very interested in silver because the price action for silver is very unique. It looks like for many years the leverage of paper contracts to physical silver is unimaginable. The COMEX and the large banks have already pleaded guilty to manipulating and suppressing the price of silver using these paper contracts. The latest data shows us that the COMEX is trading 233 paper contracts for every physical ounce of silver. So that's a 233 to 1 leverage ratio. And with gold, if you use the old classical gold standard of 40% of backing the currency, it would need to be about $15,000 per ounce in today's purchasing power. So what is next for the precious metals? There's a lot of people that are really thinking that gold and silver should be priced much higher.
Well, first of all, if we would go back to the gold standard, if the whole system collapses, the one that Nixon abolished, it would be about $36,000 for gold.
In today's purchasing power?
Yeah, today. If they
so an ounce of gold would buy you, if we go back to the gold standard, it would buy you about 30 times what it buys today. But
I'm sure you calculated it, so that will be correct. It's just too early. It's too early. According to the cycle, it's too early. It will take until next year. Again, if you want to know exactly, you look at our research when the whole, thing goes off. But if we don't go back to the gold standard, we'll go to 20, what do we have here? 24, 45, 24 and a half. That's the target that we have.
$24,000 per ounce?
No, sorry. No, 2,450.
So if we don't go back to a gold standard and we just have a market tanking, you do see gold performing very well in a market panic.
Yeah, but it doesn't have to do anything with the market panic. Again, I don't know. I'm maybe older than you. I was having a firm on Wall Street in 1987 when the crash was there. And because people were afraid that this would lead to deflation, the gold price came under huge pressure. So you can't say that there's going to be a market crash and that brings the gold up. I mean, I understand people want to make connections, but we look at it just separately.
Sure. Well, I wasn't implying that gold automatically goes up as the market goes down. What I was saying is you think that two things will happen at the same time. You think that the S&P 500 and the Dow are going down severely. You think gold is going up. I wasn't connecting the two. I was just saying that they, according to what you told us, they will happen at very similar time frames.
But not at the same time. The market will go down long before gold will start going up.
Okay. What do you think about silver?
Well, it's about the same story. I guess there's a gold-silver ratio that might change a little bit, but the same period silver will also go up. But we'll have to wait till next year. But again, first the market will go down before we see a market going up in silver. Now I'm just looking here at the cycles. It could take till July next year until we see a real big move up in silver.
Now, what do you think about cryptocurrencies? In the last 5 years, people who basically gambled early with Bitcoin and with Ethereum and Monero recently and Stimit and Dash, all of these cryptocurrencies that have succeeded, some people that even friends of mine have become millionaires. But you do see risk in there. There's so much risk in the cryptocurrency sector. It's so new, it's so pioneered that a lot of things can happen. What are the real risks for cryptocurrencies?
Well, the risk is that governments will do something because they think it's whitewashing and criminal money. But let me just quote Warren Buffett in 2000 when he says, "Why don't you invest in internet companies?" He says, "I only invest in what I know." And I don't understand this, so I stay away from it.
Understood. Yeah, it's a big topic right now, Charles. The problem of taxation with cryptocurrencies and what's going to happen to the privacy of cryptocurrencies if people start getting taxed for it, and if the government says, "Hey, you just made $1 million. We would like to see some of that income," and start treating cryptocurrencies as some sort of an asset.
In Europe, they have a reverse proof that the the government says, "I think you made this and this amount of money, pay taxes, and if it's incorrect, you have to prove that we're wrong."
I know. Yeah, it's in a lot of countries like that. So
that's complicated.
Yeah, they even if you sell something prematurely, they can come in and say, "I don't think you sold it for that price." I know a friend of mine, this is a very personal example, but a friend of mine bought a property which the contractor was about to come in and fix up. and he bought it for $150,000, and he knew that once it was fixed up with no additional capital, he can sell it for about $250,000 in less than 5 months, which was the time it took to construct the property. But instead, he sold it to the contractor for $150,000 like a few days later, because he wanted to get in on another deal. And the IRS came and said, "Sir, there's no way that you sold it for $150,000 where you knew that you can sell it for $250,000 just a few months later. What have you done with the rest of the money? Why is the transaction only $150,000? Where are you hiding the rest of the money that you received?" So they didn't believe that he took a lowball offer, $150,000. So and they actually served him with a bill. He had to show and prove that this was legit. So I know exactly what you're talking about, and in my opinion, that is the biggest concern for people who made money with and are making money with cryptocurrency. I know I used my own CPA to investigate this because I need to declare mine. So and there's only a few specialized cryptocurrency CPAs in the States. It's very important to look them up. Anyways, going forward, I want to talk to you about entitlements. We had Daniel Ammerman up last week. The guy has done such an extensive research regarding the unsustainability of the promises made by governments, like you said, 100 years ago, 150 years ago, when politicians started to campaign on the fact that they will pay pensions. And obviously people loved that because it introduced a new idea where governments would pay money to the citizens. And today we're seeing that demographics cannot sustain the type of promises that the US government has made to them. Social Security, Medicare, Medicaid. Europe is getting old, even older than the US, Japan. What will happen with these entitlement programs?
Well, they will run out of steam, and slowly they will cut the amount of money that people will get. Like in Europe, people now have to work until they're 67 or 68 years old, and soon they're going to say, well, you live longer, and so you have to work till you're 70 years old, and that's one reason how they will try and solve it. Now, of course, if you're stuck with what I said, is you all the time money comes in, and you have to do something. So for years, money came in now, and you didn't get any rate of return, but you had to buy 10-year notes, 5-year notes, so you don't get income. Now, you're still helped by the up move in stocks, but if the stock market goes down, you're in really big trouble. So it's not going to end well. But like I believed in the Fed with Greenspan and Bernanke, and they all knew something is wrong, but they tried to postpone it, not under my ruling. You know, I don't want to have a bad name in history. So whoever's a politician now tries to keep it going and hopes that there will be somebody who takes it out of his hand in 5, 10, 15 years, and that person will be held responsible for the mess.
What kind of mess are you seeing? I mean, the U.S. is a country that is unlike any other country. There's 450 million guns in the U.S. There's 80 million boomers who've been sold the American dream. They're just waiting to collect their Social Security, their Medicare, their Medicaid. Some people are really dependent on these funds. The saving rates in the United States are horrible. Most people don't have more than $10,000 saved for retirement. People live to 100 years old today. Centurions, this age group of over 100, is the fastest growing age group in the world. There's going to be over 500,000 centurions in 20 years from now. Who's going to sustain this? How will this dissolve itself? Obviously, the fiat monetary system, where it can issue credit and credit and credit, so long as the fate of the people in their currencies is there. So do you see postponing the retirement age is not going to be sufficient? Even if you postponed it to 72, and even if you postponed it until 77, the numbers just don't add up. There's so much money promised that there's going to be broad cutbacks. There's people are gonna take a very rough haircut to what they were promised.
Well, you remember seeing the slogan a couple of years ago before the crash, "Be happy, don't worry." You remember that one? And that was the attitude that usually comes at the end. You have to understand there's a 250-year super cycle that started like in 1780s with the Industrial Revolution, and the 30s, which were terrible, were just a temporary setback. But now we're at the end of the super cycle. We have very low interest rates. We're at an expansion, but the GDP didn't get much above 1.5%. So we're close to the end of the whole financial system, and there's nothing they can do anymore. They did everything they can. They went off the gold standard in the 70s. Then they says, well, we don't like depression, so we pour in money to keep the economy going. And instead of having sometimes a big setback, we have shallow recessions until it doesn't work anymore. And it simply doesn't work anymore. And it's very bad for the people who are getting older now, and also for the younger people, because not only the older people, but the younger people will be out of work, and it's going to be a big mess, and probably will lead to major wars.
So you see major wars coming?
Right, correct. Because, except of that the cycle show it, Freud used to say that if you have internal problems in a country, you look for an outside enemy. So you create a war, and then everybody stands behind you because the country is being attacked. So that's the outside enemy. And they forget for a moment that there's an inside problem.
Sure, that's been done countless times in history. Let's talk job creations here, Charles. What sort of industries, what states inside of the U.S., what countries, who is going to flourish going forward? The next 2-3 decades, there's a huge move of wealth from west to east. Is this going to continue? Do you see Indian entrepreneurs and Indian companies and Chinese companies coming in and buying up U.S. assets, U.S. real estate, European real estate? Are we seeing the end or the decline of Western dominance over the equity markets, and everything is moving to the east? What do you see? The young people of every nation, the people who are now 20 to 30, even 40. What jobs are going to be the jobs that matter going forward?
Well, first of all, there was a Professor Kondrachev in the 20s in Russia. After him, it's called the Kondrachev cycle. It's a 60-year cycle.
I think the guy was executed, correct?
He was executed because he said that the communism is going to lose against capitalism. And he proved that in every new cycle of 60 years, another continent is going to be the leader. So right now we're in a situation that Europe is on the bottom, United States is right in the middle, trying to hang on, and the East is the leader now, is going to be the leader for the next 60 years. So we talk about China, Singapore, Australia. That's where it's all happening. Now, the job market, you don't even know next week what kind of technology there's going to be developed. So it's very hard to say where the new jobs come from. What I understand is the robotic firms, that they are being very strong. And if they make enough robotic robots, then, we're going to lose more jobs. But that's very hard to say what is going to be next year. So let's say the next 10, 20 years. What we know is we're in for very hard times. We're in for a lot of tension between countries based on what we talked about before. And what we know, if you really want to be in a place where it's really happening, you have to be also from India and to the east.
Interesting. I want to last touch on the opportunities to short. You said you're looking for major declines. You said that there's going to be a panic sell. And I want to know what type of short opportunities people want to hedge their portfolio, want to even profit from the downside. What do they need to do, or what type of industries are obsolete? What type of companies are you looking for to short, or what currencies are you betting against?
Well, I'm not good enough to say which companies. What we will do is we will short the bonds. We were short already the bonds for a long time. I think the bounce is almost over, so it's time to short the bonds again. it's going to be soon. It's going to be time to short the stock market. One of my favorite ways to play it is the VIX. The VIX is not trading almost at all times lows. I don't think it has ever been lower. It's around 9.5, 10. It can still go lower. Now,
for our audience, for everyone who doesn't know the VIX, it's the volatility index. It's basically the fear gauge for the entire market. It's what most traders base their option premiums on, and the market looks at the VIX as a contrarian indicator. When the VIX is very low, like it is today, close to all-time lows, it means that there's a lot of investor complacency, and any negative news can spike the VIX. And obviously when the VIX is up, like in 2008 when it was trading for 800% higher than today, this means that it's a panic sale, and it's a good time to look at going long again. Am I describing this correctly, Charles?
Yeah, just I would like them to look at our research, because there are a lot of victims of people who don't know how to play the VIX. There are a lot of ways of playing the VIX and the different contracts, and it's very complicated. But in short, if you have a VIX is around 9, you should know that the future of the VIX is around 17, 18. So it's not 9. But every situation, like for instance, the down move in 2015-16 brought the VIX already to 52. And in 2008, it went as high as 90. So you can imagine if you buy a bit long-term calls with a strike price of 20, and you buy them maybe for 90 cents, and in a normal correction, the VIX goes to 50, and if it gets bad, it can go to 100. You can imagine what you're doing. So you hedge your whole portfolio. So we're not good enough to say which stocks you should hedge, because as we did in 2007, by the way, you can take a look on the website, and December 2007, our price target of 14,500 was hit. And I was on CNBC, and it says everybody should sell everything. So we don't like to fool around like that. We sell everything, and then we also try to make money when it goes down. So the different ways that we're going to play it, but one easy way is that most people don't know is to play the VIX, especially if it's very low. Because if the VIX is now, I'm not talking about the future, I'm talking about the VIX being 9. Now I'm just looking here in the history going back to the 80s. I don't think I have ever seen it lower. So if you go short the S&P and the S&P goes up of 5 or 10%, then you're already in problems. So here, you would consume it cannot go lower. The only thing is you're going to lose some time premium. So the risk is less than if you short an index that is still going up. You lose time premium and it goes against you. But again, to play the VIX is kind of complicated. So I don't want to say too much about it. I really want people to take a look at our research, and we get them through it. But I would advise everybody go out of the market, think which stock doing well. I remember people go, oh, you're from Goldman Sachs, give me a tip. And if you say get out of the market, yeah, but how about this stock? And then I say, listen, I'm not clever enough to find that one stock that is not going to tank when the whole market goes down. You have to start with understanding the whole index and the whole direction of the market, and don't try to figure out which stock is going to hold up a little bit and which stock is not going to hold up. I challenge anybody to find in 2008-9 a stock that didn't go down when the whole market came down, and it's always like that. So the first thing is don't lose your money and go out of the market, and then if you want to follow us, then we tell you how to make money on the downside. Now, also the bonds is something that you can play on the downside. Now, there's always a situation with crude oil. After this rally is over in the euro, we're going to see one more move down in the euro. We do natural gas. We do Australian dollars. There's all kinds of possibilities that you can make money on the downside.
Thank you very much for coming in and sharing with us everything today. Where can people find your research?
If you go to charlesnennerresearchcenter.com and you ask for a trial, they're not going to charge you. After a while, ask for the trial from the newsletter. It comes 4 times a week. On Sundays, it gives a printout of the system, so you see exactly what we see on the computer, so you don't have to take our word for it. And after a couple of months, you know, you might get a call. Do you like it? If you like it, you can take subscription. If you don't like it, it's also fine. it always proves itself. So we're not in a hurry to sell anything. We just like to help people not to lose their shirt in the next down move.
Charles Nenner, head and founder of Charles Nenner Research, one of the brightest people in finance. Thank you very much for coming in today.
You're welcome. Bye-bye.
We were joined today by Charles Nenner, one of the greatest analytical minds of our era. Let's make sure we recap what's down the road according to his systems. First, Charles sees a crash in U.S. equities, as I see as well. Charles believes the Dow will go down 75%. I have a more moderate viewpoint of about 40% to 50%. Before Wealth Research Group sees this melt down, we see a melt up. In the coming year, stocks will go up in the US, in Europe, and in emerging markets. This we call the melt up. As the suckers who fear missing out buy stocks for the first time since 2008, and I'm talking about your average retail investor that will get a call from his banker or his broker, and he will tell him, look, this thing is going higher, it just hit all-time highs, you got to get in. The market will begin to tank as smart money will sell their expensive shares, and the retail investors will pay the price as they usually do. Charles also sees gold later rallying to 2,500 or higher, and silver making similar progress. At Wealth Research Group, first of all, we help you to educate yourself so you don't buy these expensive companies. There are only a few inexpensive companies that trade for fair prices today, and you can find them on wealthresearchgroup.com website under the tab on the front menu called Wealth Stocks. We are also studying the precious metals and industrial metals closely. These markets will see a coming bull market that will be something that will shock most. After the most brutal commodities and TSX Venture bear market of all times, the market is ready and poised to go up as soon as the S&P 500 and the Dow start tanking. Go to wealthresearchgroup.com/gold playbook for our entire manual on gold stocks, and download our highest quality companies, the companies that we watch right now and conduct our due diligence on, so you can have that watch list in front of you at wealthresearchgroup.com/watch list. Join us next week as we continue to have important shows that are lined up for you, and thanks for taking the time and educating yourself today.